the best I can be at this. This is like a golf game. You're never going to shoot an 18. You're always striving for a better score and to get better at this. But the difference between me and the average guy is that I make smaller mistakes, and my expertise is my good stuff is better, and my bad stuff is less, and I'm able to manage it in a way, but it's still imperfect. I am not perfect at all at this. I make all kinds of mistakes, and I'm still learning every day. Everybody is.
Mark, I
Everybody.
don't know if you're able to pull up your charts again, but ADM on the intraday is setting up a real just right now as we
It
speak
just
for you
went. Oh,
now.
it just went into new highs here. That's good. Good. Once
But
again,
look,
we're erasing some of my
look
luck
on
in
the
the middle
intraday
here.
on the 5 minute, you'll see a setup that
Yeah, I'm not really set up for that right now, though.
yeah.
But I
If you're
see it.
looking at
I see it
ADM
came
on a
out a little.
5 minute
It's a little.
chart.
I have it on my other on my order entry screen. I can see it's a little mini
Yep.
VCP. It's coming out of right now.
Yep. And also even
Classic Bob, always pointing those out.
I
that's
know.
that's how I do it. So I'm working off of the daily chart, stocks that we have a swing trade on based on a daily chart. And now you're just looking for that incremental opportunity to trade around that core with these types of setups. And you're on that type of mini VCP on intraday, you're talking about,
There it is.
20 cents of risk.
There it is.
20 cents of risk. You
There's
could
the
get
chart
an
here. So
extra.
we're at the high of the day here. Can you see that?
Yeah. Yep. We do.
We're at the high of the day. So this is acting really well. And what Bob's talking about is right here. Here's this little mini VCP. See how even on the 5 minute, look here. You have your little cup with candle right here. Here's a VCP breakout. Okay, comes back. Natural reaction, right? Tightens up. Low cheat or cheat, whatever you want to call it. Handle. Look at quick breakout. Now, same thing. Go through VCP breakout. You think it's a coincidence? You think it's a coincidence that the price action forms the same pattern over and over? The volume dries up, and at the same areas, it expands. The advances are strong coming out of those areas. Weekly, monthly, daily charts, intraday charts. You think that's a coincidence? After millions of charts, I've seen this. Millions. I've done hundreds of thousands of trades. This
Look
is
up
it.
Monster, Mark. Also, Monster, same idea. We have a stock on a trade, on a
Right.
swing trade based on a
Right.
daily chart.
It came out a little. Here's the little cheat area right here. Come out.
This morning.
Natural
Now
reaction
you're-
here. You're even
now
getting
you're
a
setting
little.
up.
You're even getting a little failure reset. Came out here. Now it came in, and you get the failure reset, and there you go. There's a little pause pivot. Like if this was a daily, you'd be buying it right here. Now that the question will be asked is, well, can we buy this here on intraday? Sure, but the move might be $1. It might be 50 cents. Everything's going to be way compressed now, so you have to realize that.
But I know plenty of folks who come to the programs and trade. Bob being one of them. Bob will Skype me. Hey, did you see the little 5 minute VCP? It's like, no, Bob, I'm not looking at the 5 minute. But they're everywhere. They're everywhere.
Mm-hmm.
And then and this is, keep in mind, guys, the Nasdaq's down a full percentage point today. The market's down, and our stocks that we're looking at are up, completely ignoring the market, and even though the market is getting a little rally here right now in the last 5 minutes or so, but that just shows you
exactly what I said. Remember, I said we might get a later day rally, and then the stocks that broke out will pull in a little bit, but won't stop you out, and then they'll strengthen into the end of the day. It's exactly what's happening. So we'll see how we end the day here. But again, this has to be put into perspective. If we're assuming this is the daily, then this is the weekly. So we have to see what are we in a late stage base? Are we extended? So this could be coming from an extended period, and then we go back to those sell rules. Where is it a breakaway move, or is it an exhaustion move? So it still has to be put into perspective. If you're going to trade on the daily has to be put into perspective with the weekly and the longer term. Just remember this. Here's the general rule, and I should put this. I had this in the workbook before, I think, somewhere. But your current chart is only as good, a shorter term time frame is only as good as where it resides within the longer term time frame. All right, if you're intraday, it's only as good as where it resides within the daily. And the daily is only as good as where it resides in the weekly, and the weekly is only as good as it resides in the monthly, and so forth. Why? Because if we're in a downtrend, well, then sideways action and line of least resistance is going to be on the downside. It's going to be on the downside. If we're in an uptrend, line of least resistance could be on the upside, because in a downtrend, we now have big institutions are selling. There's distribution. See, we're requiring the win to be in the sales. The whole idea of the supply not coming to market and weeding out the shorter term players and the weak hands is because we're making that assessment that there are big players that have an appetite. And that's what creates the supply demand imbalance. On the flip side, when you get that no supply, well, the supply demand imbalance is on the supply side. You're in a downtrend. The big money is selling. So you create the line of least resistance is to the downside. And now you'll be looking to short. So it has to be put into perspective. And that's why I started the whole workshop off with reference points. We have to have reference points and a chronology to this, that you have to understand where you're coming from and have those qualifiers, because this doesn't work if it's not put in the right context and stacked in the right direction with all the probabilities all stacking on top of each other. When you get it all right, though, when you're in the right environment, it is magical. That's all I can tell you. Absolutely magical.
That does lead to a question with the intraday stuff, but a
Go
question
back to the
was
workbook, or are we going to stay on these charts here? We got questions on the
just
chart.
a general question. Do you trade in the first 30 minutes or 60 minutes? Some people say
I
to
do.
wait.
Yes, I do. I don't wait. First, couple minutes, if something just comes ripping out in the first 10, 15 seconds, I pause usually, and I see if that's a quick, if they're just taking it out on low share. Sometimes they just run it up a couple hundred shares right on the open. I take a little pause, but no, I'm buying the stocks when they break out. I'm letting the chart dictate, not the time in the morning.
Question being asked: any other tools one might need besides Marcus Smith for screening to complement trading your strategy?
Just some a quote system, and real-time charts, and Market Smith I use for just screening, and that's pretty much all you need. I mean, you want to get something for earnings reports like a briefing.com or some of, a product like that for checking news. But you don't, it's like the beautiful thing about trading, it's just like poker. There's a saying, all you need is a chip and a chair. And then guess what? Then it's up to you. It's up to your talent. Just like baseball, all you need is a bat and a glove. And then it's all based on how well the operator, how well you swing that bat and catch the ball and throw the ball. In bowling, you need a bowling ball. That's it. A bowling ball. You show up, it's up to you now. Boxing, two guys put on boxing gloves. Best one wins. That's what this is about. You don't need a whole lot. It's down to you. It's down to the skill. It's not, there are no programs. There's no indicators that are going to make you rich. It's you knowing that indicator. And if you're going to use stochastics, great. Then I'll tell you what my father used to say. My father used to say, I don't care what you do. Whatever you do, though, just be the best at it. Do the best you can. Whatever it's going to be. But go all in. Don't pussyfoot around. Go all in on it and be your best at it. So that's it. I picked this particular style, stayed with it for 40 years, and became an expert in something. That's what I advise you to do. Pick something. It doesn't have to be this. It could be something else, but pick something, because you're not going to be good at everything. And there are no magic formulas or indicators. It's going to come down to real work. If that was the case, everybody'd be worth tens and hundreds of millions of dollars. Everybody would be like Mark Minervini and be able to make all this money from trading stocks. But that's not the case. Very few people can, because it's a game of skill where a lot of money goes from a lot of people to a small group that are skillful, just like in baseball. How many pitchers get tens of millions of dollars of contracts and quarterbacks and it's the same principle anywhere. There's a small handful of elite performers that get it and commit to it and become great. Got to give yourself the time to become great. You got
Question
the
being
tools.
asked.
You got the tools. Now, do you have the wherewithal? That's the question. Do you have the willingness? Do you have the discipline? Do you have the commitment? Do you have the wherewithal? Do you have the ability or the willingness to commit and to stay the course? You have the tools. I promise you, I gave you everything you need.
Question being asked to Mark Ritchie if he had any special strategies on incorporating all the content you learned from the Master Trader program yourself. And just making a comment, he assumes it took some time for all these strategies to show up in your trading results.
Sorry, here, chewing a little bit.
Not really, seeing as you won the triple digit challenge in the
In
first
6
6
months.
months. Didn't
That's
take
nice.
very long for Mark Ritchie.
Let me put in a few caveats. Well, the first thing I did, first of all, I think that you phrased it strategies, Bob, or something like that. So I went home and just started screening right away. I actually never screened a stock before coming to the first Master Trader program. I didn't know anything about it. In fact, the service, the MPA and all that this was all kind of coming out new at the same time, So talk about those of you guys who feel like you're drinking from a fire hose. I felt the same way. I think I even got the screens I'm using now. I think I got from somebody else who was attending, because we didn't even have a section, Mark, remember, where we went over the screening process. It was just sort of some general guidelines, stay away from stage 3s and 4s.
Right.
You guys are getting more now than
I think the workbook was like 180 pages. Now it's 530.
Yeah.
There's a lot more meat on the bone for sure.
Yeah.
We definitely did not share any of Mark's screens in his first few years.
No. And long story short, I just started screening and looking for the pivots, and I had already been swing trading, and this style, I would say, fits my personality. There's no question about that. There were some things that were definitely intuitively easier for me, as I've tried to teach this to other folks on the platform, whatever, realizing you get a lot of the same questions that people just have a harder time grappling with some of these ideas. But for me, I would say the biggest thing was just refining your eye. I look back at some of my old stuff. I was like, that was sloppy. This was sloppy. Just getting more and more refined in how you see things, catching more little nuances in the charts. And then, look, I went to every weekly Q&A session for, I don't know, 5-10 years, asking questions just like everybody else. After a while, I didn't ask many questions because, then I'm just trying to provoke Mark to get on tangents, because you could still pick up lots of good gold nuggets in terms of what does it take to be successful? How do you think about this situation? How do you think about that situation? Mine has always been too, if I'm in the right frame of mind, I'm going to make good decisions. And so if I'm thinking about things correctly, I'm a big believer in, from right thought comes right behavior. So that's really what these last 2 weekends of me are really all about, teaching you how to think about these things and dispelling some of this nonsense you hear out there in regards to, you want to trade volatility or widen stops and, averaging down, all that kind of stuff. And then the other thing I would just add, though, one thing, as the account grew, trading size definitely took some learning, because initially, I would just buy it all in one hop, where you could turn your whole position over really quickly. That definitely took some getting used to and learning how to do that properly as well.
Yeah. So with regard to the charting, it takes time, and it's all right here in front of you. And again, I would caution you to, as Mark is saying, to narrow it down and try to insulate yourself from the noise. That's our goal here, is to show you what you need to focus on and how you need to think, and then it's up to you, to spend the time putting it into practice and gaining the experience.
I will add one other thing too that I've always encouraged people is to, I've never been a journaler, mainly because I have a really strong, I just have a memory, where I can remember certain things. But I think most folks that I've seen that have been successful at any type of trading, every now and again, they sort of have these aha moments. And the golden nuggets really, I think, are designed to sort of pull those out of the material, but you'll have them in your own trading. And so there've been a few where, everything just lined up and you saw things, work out right. And I feel like you just kind of have to go through some of those to say, you know what, when I see this again, and the reason we tell the COVID story, I've seen lots of ways of setups, never one where I thought the world was going to come down to an end.
Yeah.
And, I just know if we ever get into a period again where people are that skeptical, scared, pessimistic, and the stocks are setting up, if I could be even more aggressive, I'm going to be even more aggressive. So the longer you do this, it will just increase your confidence. And every now and again, you have one of these moments where you go, now I get it. Now I see it. So I just encourage you to write those down as they come.
And the only reason why I probably was able to tell Mark Ritchie in the first couple months of the rally off the COVID bear market that we're going to buy the stocks is because I had seen the potential world coming to an end. Not that was completely different. I have to say that was more scary than probably anything that I've ever seen. Although 9/11 was pretty scary when it was happening, and the '87 crash. But I wasn't really involved as heavily as I am or was later. But I went through the '87 crash. I went through the bear market in 1990. I went through the 2000 bear market for years. That was 3 years long, and the World Trade Center coming down, and the 2008-9, financial subprime debacle and financial system collapse. I had gone through a bunch of those, so I started to learn that the market discounts this stuff, and that I gotta let the head, not the tail, lead me here. Otherwise, I probably wouldn't have bought any stocks, and I would let my emotions over. So, I had to trust my experience. And before you can trust your experience, I guess you got to trust somebody else to a certain degree. And that sort of bridges you to get your own experience. But you're probably sometimes going to be where, even though I told you all these rules and Mark Ritchie told you all these rules, and you know everything, you might not do it just because you haven't seen it enough times and you're scared to death. And then you'll see over time, you'll see what works, what doesn't. And then if you stick with it long enough, the truth will rise to the top. Cream rises to the top.
Something else I meant to
Anything
add.
on the workbook? Because I know we keep
Yeah,
getting off the
going
workbook. But
A lot of questions
yeah, I'm sure.
put in there, very journalistic.
Problem is, when we're doing this, we get hundreds and hundreds, sometimes over 1,000 questions, and Bob sort of tries to bounce around and get questions not answer the same thing over and over. And there's a lot of questions to field. We certainly can't answer them all, but try to get all the relevant topics.
One of the things, though, when you were stepped away for a moment, Mark, that Mark Ritchie was answering the question of sort of how to manage a trade, essentially. And one point I wanted to just emphasize was, if you listen, Mark and Mark both have a plan of not only getting into the trade, but they also are visualizing all the scenarios that could happen once you're in the trade. So what if the stock continues going up? What if the stock starts pulling back? They already have an idea of what they're going to do in certain circumstances, no differently than playing sports. If a second baseman knows the ball is going to be hit to him, there's a runner on first, he knows he's going to go to second, or whatever might be the case. They're already pre-thinking through, visualizing exactly the scenarios that can happen. So nothing surprises them. And that's something I think
but
is
again,
helpful.
yeah, I think you still got to be careful what you say, Bob, because that almost infers that we've got targets, and I can be very surprised. But I have a response. What Bob is saying, that I have contingency plans and a response for everything. For instance, if I'm surprised with a giant, this stock gaps up huge on me, or takes off right now on news, I know if it's up real big and it's extended, I'm going to probably dump some right into strength. I have a pretty good idea of what I'm going to do. It may not be an exact plan, and know if this stock goes to 110, I'm out. I don't have those hard fixed rules like that, except on the downside, on the risk. But yeah, as Bob is saying, we in our mind's eye, we're pretty prepared for just about any eventuality, and that's in the contingency planning. Like I pointed out, we ended the day 4 with some closing remarks, and I talked about contingency planning. First of all, your first plan is you got to have a criteria to buy and to minimize your loss. From there, selling at a profit, selling at a loss, selling at a profit into strength, and selling at a profit into weakness, and then a disaster plan based on your system and whether it goes down, you get locked out of your brokerage firm, then it goes to that plan. So all those things, then you, like I said, then you get a playbook, a full playbook, that you can handle just about any situation. Like, if you're in a 757, flying, the pilot, they have protocols. If an engine goes out, there's protocols. And if they don't know, they radio to the tower, they tell them what to do. There's protocols based on experience in building this playbook. And if something happens that they don't have a counter move for, they add it to the playbook. So you got to build your playbook, and that takes time.
Question being asked, if Teresa's asking, she knows that you don't like cyclicals, oil and gas and energy, but if the market in 3 to 6 months turns out that is what is moving the most, like it has been for the last 3 to 6 months, what from history would that tell you? Not sure.
Well, tell me that we're in a period where, those stocks are in favor for whatever reason. And if, and again, if we see a whole bunch of setups here, they start meeting the criteria, I'm going to probably take a few, not going to completely ignore them. I'm not going to fight with the market because I don't know. History says that these cycles move in 8-year cycles. I pointed this out in a note that I put out to our members. We're in a couple years into a potential 8-year cycle. So we still could have a long way to go on oil names and energy names, things like that. Deep cyclicals like papers and steels and so forth, I mean, they'll probably have a shorter lifespan and move with the economy. But I'm not going to dig in and not bend a little bit. And so maybe I take smaller positions and have smaller exposure. And I don't, for this next cycle, I don't make as big of a return as I normally make. That's okay. It's all right. It'll be that, as long as I protect myself on the downside and I'm making money and doing well in the market, and I'll have periods where I do really well, periods where I do only okay, and periods where I don't do so good. But over the long term, that's how I've amassed my performance. And Mark too. Mark had a few drawdowns early on, some pretty decent drawdowns off the high. He had to learn, and if you look at his performance as he's gone on in the years, the drawdowns have gotten less and less. But he's managed to have an amazing track record over a 13-year period.
Question, Vanna is asking, sort of kind of a paraphrase it, but basically she's asking why you're buying Monster with EPS, earnings per share, declining. Would this be an example of differential disclosure?
Let's bring it up first of all. So let's see here. I'm going to just widen this out here. So a few things. Well, first of all, yes, it is. I would say that's a good to point out differential disclosure. Okay, so the earnings are negative in the last 3 quarters, but the stock is hitting, I believe, near an all-time high. Right? That's just, again, this damn thing drives me nuts. Hold on, I got to move this Zoom bar. Okay, let's bring up a monthly. So we're up around all-time highs here. Look at the market. There's the market, the stock, and I'm going to go to a weekly now. So the relative strength line during this correction here, stock is acting pretty good here. And then I look here, and I see all this, these earnings where they peaked over here, and they started slowing down. And you got between 2020 and 2022, you went up a little bit, and then you came back to that 230. You're basically in that 230 range. And now you're looking like this next year, you got a breakout year where that'll actually be the biggest earnings, annual earnings. And these estimates are probably conservative. That number if they execute properly, that number will probably be bigger. We talked about that, how the estimates are conservative. This is probably a conservative number. The stock is telling you that it's acting really well. So I think we're trading on future earnings here, looking at the estimates. And the bottom line is, yeah, the stock is acting really good in the bear market. The problem is we don't really have much of an uptrend. So if we get it right, maybe we got it a bit early here. I mean, okay, so you said the negative number. I want to show you one thing that sticks out like a sore thumb, right? So you're looking at the number. Remember I said the number is, don't trust the number, trust the response to the number. Look at here. See right there? That's when they reported earnings. Look at the response to the earnings. The stock has got its biggest up move since it's turned into an uptrend here on that -5%. Well, that -5% obviously was a pretty damn good number. Had to be. There's no way the stock is going to go up on this giant volume. Let's even look at the weekly. Look at the weekly here. Big weekly move up. And look at this. 1, 2, you got 2 tight bars, 3 pretty tight bars. No variance. Like it's held that move. It's not like it popped up on retail money and then came selling off. It's holding up. And now it's breaking out here. So the stock is telling you that this future number is what it's trading on. And now we've got to see if these numbers start to come in. Future earnings reports are going to be really important because this is obviously trading on the future. It's all stocks are always trading on the future. All right. But sometimes the earnings are on the table and sometimes the earnings are on the table. You've got the earnings and it would be just the opposite. As I pointed out, we saw Crocs come up with 155% and the stock was down 15% that day. So again, you're going to look at the number and go, why are you selling that stock? The earnings came out 150. Let's reverse what you said. Why are you selling the stock? The earnings came out 155% because the stock's down 15%. Same thing in reverse here. So that's the reason why. Now, I could be wrong. This might not work. But again, if I put myself in this position 100 times, 1,000 times, and I manage the downside in relation, I'm going to come out a winner. These trades are going to deliver more on the upside than I'm allowing on the downside. And that's all that matters. Whatever earnings they come out with, it's the response. It's how the stock is acting. Now, I'd love to get it all. I'd love to have big earnings and have the big response. Those are the ones that usually give you your bigger moves and the sustainable moves when you have it all on the table. And this might happen at a higher level. This stock might be just starting to get into that strong stage 2 uptrend. And 6 months from now, 2 quarters, 3 quarters from now, we've got big earnings in the current quarter and the stock is coming out of another base. It's coming out of a second stage base now. And I'm buying it there. And that's actually a better trade at a higher level. You see, not the lowest price, the right price.
Question is being asked because of the bear market circumstances with the downtrending market. Would you look at the 3-month relative strength rating on MarketSmith versus a 12-month because that will be showing you more of the stocks that have been performing well in the last few months?
No, I wouldn't. But if you want to see what's performed well, like during a correction, versus that time period, like sometimes in a shorter term pullback, market's down 6 or 8 weeks, or in a bull market, and the market's pulled back for 6 or 8 weeks, I'll run a 6-week RS. I'll run an 8-week RS to match the time frame. You could do that. You could just say what stocks from that point do a rate of change. So what's the rate of change? And then sort it by the biggest to the smallest from a particular date. So let's just say you're going to measure it from where the market topped. And let's say that's 3 months. Well, if you ran the 3-month, then you would see the stocks that are the strongest during that period. Yeah, you can do that. I think that's good thinking. That's a very good way to think about it. But I have found that I don't need to do that. The relative strength rating is fine. And also, just so you know, the relative strength ranking in IBD, the 3 months is 40% of the ranking. So it is weighted already towards the most recent 3 months. Can't hear you.
Thank you. There was a question earlier this morning if you could pull up end phase, which was asking